Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Value Research and Aditya Birla Sun Life Mutual Fund. Today we're diving into a topic that's important for millions of investors, SIPs or systematic investment plans. They are smart, they are simple, they're incredibly popular, look like a solution to every investment problem. But here's the real question. Are SIPs as magical as they're made out to be, or is there a catch? We'll talk about it in detail with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So first up, let's begin with SIPs. They are treated like magic wands for investments. Are they really as magical?
SIP is a great enabler, but that in itself is not magic. Magic is compounding. Compounding itself, is what Einstein or Newton said, that it's the eighth wonder of the world. Rightly so, because your capital earns, and then that becomes the added earning becomes capital, and then start earning. The snowball effect, every time it is rolling, it is getting bigger. So the snowball effect of a productive asset, and what better asset than equity, and equity which is managed, equity which is from which poor investments are weeded out, good investments are let run. Nothing like that. So the magic of compounding happening at a higher rate of return because of effective or because of more productive asset which is actively managed, there lies the magic. And SIP is a great enabler. Look at it like an enabler, because it helps you do with a defined amount of time, of money, at your time of your choice, with convenience, with ability to withdraw some emergency money just in case you need it. Not that you should pull it out, but having that fallback that, just in case you are facing rough weather, you have access to that money. That comfort itself ensures that, it's a great fallback. So, and it fits in with our income cycle. You earn every month, spend every month, save every month.
Right. So SIP is a method, it's not a guarantee, and you mentioned selection of fund, how important that is. So can you explain how important is the selection of fund while doing an SIP?
Let me give you a sense of, the scale of difference over a 15, 20, 25 years time period. And that is the kind of time period you will have in mind when you're investing for a very long-term goal like retirement, or building your house or accumulating money for that. The difference between the best performing fund and an average fund and the worst performing fund could be something like having 2 crore rupee, 1.5 crore rupee and 1 crore rupee.
Okay.
And if this is the difference, the median, the outlier on the highest, on the upside and the downside. So this is a huge difference, and I'm referring to something like a flexi-cap fund, something like anchored to a BSE 500 index. If you look at this number in the small cap fund, the best fund, the median fund, and the worst fund, it could be huge. It could be 4 times that much. The worst and the best could be that bigger differential. So SIP is good, and you should have SIP. You must do SIP. But where you do it and blindly doing it won't get you that. And if you make your long-term investment in a narrower category, in a category, because narrow categories tend to be very cyclical. If you start your SIP and you expect that it is a birthright to earn more return because you have done your SIP, maybe to begin with it will do well, but by the very design of it, it is not expected to, it will not be able to ride through a full market cycle. And many a times you are attracted to a vehicle, you are attracted to a fund which has done exceptionally well in recent past. It may be a very, risky proposition, or it could be a dangerous proposition, because it's very difficult to sustain such extraordinary return over a sustained period of time.
Right. Now, you being in this industry for so long, you're a mutual fund historian, you've interacted with so many investors. So can you share with us some common mistakes that people tend to make when they do SIPs?
One thing is that investors don't really link their SIP to the real life goal. The moment you link it to your retirement, you understand how serious it is. Yeah. And then it becomes a very serious investment. You start taking it seriously, you attach weight to it. But if you don't do that, then every other day, assuming that you are doing your SIP very regularly and you get lucky with the market as well, and you have done it for a while, and then suddenly you start liking a car which you never had thought of, simply because you have not attached, you have not, anchored your thoughts around a real goal.
Right.
So that's another problem which I come across. And not reviewing periodically. People do SIP and just forget about it. They think, fill it, forget it, shut it. And if you do it, and many times I come across a situation where investors think only in terms of constant. 5,000 rupees a month SIP. And
done for years, not increasing the amount.
When you started, it was 1/5 of your income.
Right.
And in 10 years' time, 5 years' time, it might be 5% of your income, but you haven't bothered to check about it.
Yeah.
And even though that SIP experience has demonstrated that this is the magic, the compounding magic that happens with your money, and despite that demonstration, you never upped it.
All right. So now coming to the duration. How long should an investor really stay invested or realistically invest through SIPs to see meaningful returns?
So it depends, what are you gunning for? What is your expectation? But my sense is that any 5-year time period, it is difficult, a reasonable, fund selection, not necessarily the best. But if you are in the top half of, top 75% of the performing fund, on any 5-year period, it is nearly impossible to find a disappointed investor. If you are doing your SIP, chosen a good equity fund, reasonable equity fund, that is not the best of the lot, you will still be very happy and pleased with the 5-year SIP return.
All right. So if someone wants to start an SIP today in July 2025, what type of mutual funds would you recommend as a starting point?
Same what I keep repeating, even at the cost of sounding like a stuck record, that if you are a first-time investor, and you are getting attracted to that small cap or that thematic fund or something which has done exceptionally well, but go for the aggressive hybrid fund. Go for the aggressive hybrid fund because it will help you stay the course. It will help you be on track and not get distracted. If you are an investor with 2-3 years time frame, experience, you have seen the ups and downs, if you have seen 20, 30% in one month flat, and if you are able to withstand that, or if you have experienced it, then that's a very useful experience, because most of the time investors get scared out of the market on such occasions. And it benefits in terms of having a realization that it's not going to be like this always, and it happens, and you can withstand that. So if you are one such investor, maybe consider a multi-cap fund or a small cap fund, and that will provide all the flexibility, great return. And it's very important for investors to understand that volatility is not risk, and volatility is risk if you get scared of it. If the market falls by 15% and you get so scared that you take your money out, that's a risk. But if you understand that market goes up and down and you are carrying a diversified portfolio and you can withstand it, and equity markets are like this only. There will be many occasions when the markets will go up by 5-10% every now and then. And if you understand that what is real risk and what is volatility, and volatility is not necessarily a risk always. So if you get used to it, tide over it.
All right. So to wrap up this conversation, what's your advice to investors who have been there, who have already started investing through SIPs, but they haven't really seen great returns yet? What would you say to them so that they can stick around and wait for their SIPs to work better?
One is that I would like to get some experience from our investors. That what has your SIP experience been? I would like to have a first-hand input from our readers, from our viewers, that how much have you earned on a 5-year SIP, 3-year SIP? How have you calculated it? Set up your portfolio on Value Research Online, you will get a very precise sense of it. My advice to everyone will be, choose a reasonable fund. Avoid 1-star, 2-star fund. Choose a good fund, reasonable fund to your understanding. And a reasonable fund is the one which has beaten the benchmark over a 5 and 3-year period. If you can choose 1 or 2 such diverse category from the category of diversified fund, the multi-cap and the flexi-cap, that's good enough. Any 5-year period, I would say that it will be very difficult even today to come across an investor who has done his SIP over the last 5 years and would not have beaten the fixed income return by 2x. And twice as much is a very handsome return.
All right, so SIPs are enablers and they enable the magic of compounding, and you'll see it for yourself if you stick around for long enough. Now, moving on to the viewer's question, Naresh Reddy says he's a regular viewer of Hangout videos. He has a question on the amount of SIP he needs to make for the retirement, which is 20 years away. He thought of investing 10,000 monthly SIP, but finally started an SIP with 15,000 rupees monthly. But after 6 months, he realized that 15,000 is also not enough and he needs to increase the amount. So now he's thinking about investing 30,000 rupees. So can he choose a different fund with 15,000 rupees more, or should he do it in the same fund? He's confused about the amount to invest and how to choose funds. His goal is to generate 10 crore rupees over 20 years.
For his retirement target of having 10 crore after 20 years, it's a very difficult projection, because you have to make a lot of assumptions. How much will the investments earn over this period? What will be the prevailing inflation? What will be, that is why I was saying that invest as much as you can. But based on some assumption, I can tell you, is that if the money is going to, if your return from investment is going to be 12% annualized per annum, and you are going to be a regular investor over the next 20 years, month after month, then you need to invest 1,10,000 rupees every month, so that it accumulates to about 10 crore in 20 years time. Life, markets, and the whole thing does not move in a very nice straight line. The markets don't, and your earnings too. If you are doing well in life, your earnings grow, and your earnings grow much faster, more so in the initial phase of your career. And after that, it's steadier. And then depends, how vulnerable or how risky or how enterprising or how rewarding your line of career is. I would say that invest as much as you can. Else, make sure that you are investing 1,10,000 rupees, which earns 12%, and it will become 10 crore.
All right then, thank you.
Thank you.
Well, if you like the show, do subscribe to our YouTube channel. Keep watching the space for more information. Thank you for watching. Bye for now.